this $10,000 a month deal, Passive Income, Covered Calls and Stocks by Mark Yegge. A few people have asked me to review this. I have never watched any of his videos before, so I briefly went through this video. I don't feel that he's explained his trading strategy very well, and I'm also pretty confident that this trading strategy could potentially lose money or cause so much stress that it wouldn't even be worth trying. Alternatively, I can almost guarantee that this strategy would underperform the market, as every single covered call ETF strategy dramatically underperforms simply holding the SPY and not doing anything. Because when you sell covered calls, you're sacrificing the upside potential and you're essentially holding downside risk. Yes, you're picking up a little bit of premium, but this type of strategy would fail miserably during a market crash, and during a bull market, you're also sacrificing the upside potential. Then there are other things which he didn't mention, where if you're going to synthetically go long the stock by buying a long-dated in-the-money call option, and then you sell an in-the-money call option where your broker is going to potentially force you to close out that position for a large loss, because when you sell in-the-money call options, especially on highly volatile stocks like Tesla, which went up around 50% immediately after President Trump was elected, your broker is not going to be the one to carry that risk. Instead, they're going to force you to close out that position. Once it starts moving against you, the amount of money that you're going to have to pay to buy that back is going to be astronomical. But I'm probably talking way too much here, so let's go through this video.
I got a question for you. What if I asked you if you'd be interested in making $10,000 a month, having a 75% chance of doing that, and having to invest $250,000? Would that be interesting for you? Would either of those two be interesting for you?
The probability of that happening in real life is close to 0%.
Either one of them is interesting for you. Stay tuned. I'm going to show you how I make money using an in-the-money covered call strategy and see if it resonates with you. Here we go. All right, so let's say that you wanted to own a stock. Let's call it Tesla, pretty good stock. And you wanted to give somebody else the right to buy your stock at a certain price. You're willing to limit the upside. So you're willing to say, you know what?
That's exactly true, and that's one of the downsides. And this is why covered call ETFs always underperform the market, because you're sacrificing the upside potential. The amount of premium that you're collecting does not offset the capital appreciation in the underlying security.
I'm limiting the upside to, say, $260 or something like that. And you said, listen, if it goes over $260, I'm not going to make any money over that, but I will get $10,000 for waiting. Okay? So what we do when we sell covered calls, we buy a stock, we buy an asset, and then we give somebody else the right to sell us that asset at a predetermined price, like $260, before a predetermined date, like a month from now. And so that's what we get paid to do. We get paid to hold the asset and give that to them if it goes up. Now, if Tesla goes up a gazillion dollars, you're only going to get $260 for it because you have to sell it for $260. So you limit your upside. Right here, these $260 strike price calls are getting about $10 worth of juice. Now, let me show you what you're looking at. You've got a bid and ask price. The stock right now is about $287 or something like that, $288, somewhere in there. It doesn't really matter that much. And you're going to be buying the stock for about that price, and you're going to turn around and you're going to sell somebody the right to buy your stock from you for $260. And when you do that, you'll get a benefit of putting $37.70 or a little bit more, probably about $38 back in your account per share. Okay, so let's say you did 1,000 shares. Well, that's going to cost you $287,000, but you're going to get back $37,000. Okay, so it's going to cost you about $250,000, something like that.
Okay, so the problem with this strategy is that if you buy this stock at $287 and then you sell the $260, so therefore, yes, you reduce your cost basis, but your maximum gain is $10 and your maximum downside is $277. Then if Tesla goes up to $350, again, your maximum gain is going to be $10. So basically, you're giving up the upside potential, but you're assuming all of the downside risk less $10 a premium.
So you give it 250,000, but you go over here to this column that says extrinsic value. That's the amount of money that the gambler gives up, okay? And that goes down in value as it approaches expiration. When it gets to expiration, it's worth a big fat zero. So at the end of June 6th, it's worth zero, but you get $10 for it today. You also get this intrinsic value. See this column called intrinsic value here? That's the amount that the stock is in the money. The option is in the money. So you pick up this intrinsic value here of $28.45. That's $2,845 per contract. And you also get $1,000 per contract. So 10 contracts or 1,000 shares, you get $10,000. You with me so far?
The intrinsic you're already paying for by buying the underlying security. So your maximum profit is going to be $1,000. If Tesla went all the way up to $350, you would only profit by $1,000. You wouldn't profit in any of the upside, and then your shares would be taken away from you. And then what would you do? Eventually, you're going to end up buying the shares at a higher cost basis, and then we're going to have a situation where the market pulls back, and you're going to be left holding the bag.
Now, you might be going, Mark, that's a lot of money. That's $250,000. And I'm only doing it for $10,000 in a month. Oh, I don't know. I think it's pretty good. Think about it for a year, 12 months, that's $120,000 in a year on a $250,000 investment.
Again, that doesn't even make sense to me, because if he's long shares and then he's selling an in-the-money covered call, then that covered call is going to take away your shares from you. If it doesn't take away your shares, then there's a high probability that the underlying stock has fallen below the short call strike, and there's a high probability that you've lost money on that trade. But if it does take away your shares, then that means that the underlying security has gone up. Therefore, you're going to end up buying back those shares at a higher cost basis. So it's not going to be $250,000 if you're going to buy 1,000 shares of Tesla. Instead, if Tesla goes to 300 or 350, then you're going to end up spending $300,000 or $350,000.
50%, but pretty close. On a stock that I don't know if it's going to go up, I don't know if it's going to go down, but I don't think Tesla is going to be out of business in a year. There's also one other strategy that I'm just going to
Right, but if it goes down, then you're going to end up losing money.
Because right now, a lot of people who know about options go, Mark, what if you sold a put? Now, a put option gives somebody the right to sell you the stock if it goes down to a certain price. So they're benefiting by the stock going down, and you end up getting it at a certain price that you agreed to. You get the same amount of money whether you sell an in-the-money call or you sell an out-of-the-money put. The difference is I get to control when I buy the stock and what price I pay for it. Here, you don't get to control when you buy the stock. You end up buying the stock probably on its way down. If it goes down at 240 and you say, well, I like Tesla anyway, I'm happy to own it at 260 and then I could sell covered calls against it. That's what a lot of people do. They call it the wheel strategy. That works. That's valid. I just don't like the negative mindset that you have to end up owning the stock on its way down. So let's say Tesla has some bad news and all of a sudden you own the stock at 260, but the stock trades at 230. Well, you didn't really get much of a choice. It's very similar mathematically, but it's mindset, it's totally different game. Now I'm going to sweeten the deal for you, okay? And you don't get this option on the put side. Let's say instead of buying the stock at $287,000 for 1,000 shares, instead you went out here and you went to say September 19th and you said, I'm going to go deep in the money. So I'm going to be controlling the same amount of shares, but instead of spending $250,000 or $287,000 in my first example, you're going to end up spending $108,000. So you could spend a fraction of that. You'll buy these 190 strike price calls. So anything over 190, that's in the money amount, right? So the stock is at 288 above that. So you got some intrinsic value of about $100 and you got to pay a little bit of extrinsic value. That's a cost for owning this, but not having to spend a whole bunch of money. Make sense? So you spend a fraction, less than half of the amount of money that you spent before, but you're still getting the $10,000 in income in the month. How about them apples, right? Now you're talking about $10,000 a month on $108,000 invested. But remember, you're getting back that $37,000 when you sold it. So you're going in the money. You're also getting that $37,000 back. So you're not really spending $108,000. You're spending roughly about $70,000. So you get $10,000 back. Think about that. In 7 months, you pay off the whole position, and you still have all that in the money amount that's got some value if the stock doesn't move at all. So here's the math.
Okay. All right. Buying the synthetic is one of the dumbest things I've ever heard. If you're going to sell a short dated in the money call option against a longer dated in the money call option, the problem is that those short calls are going to end up getting assigned. And then you're going to be short 1,000 shares of Tesla at $260. The buying power requirements on those short 1,000 shares of Tesla are going to be astronomical. Remember, Tesla went up 50% in 2 to 3 weeks after Trump was elected. There's no way that your broker would allow you to assume that risk without forcing you into a margin call and forcing you to close out that position, because your broker is going to look at it and think that Tesla could potentially go up to $450. So you're going to be short shares, whereas your long call option is going to increase in value less than you're going to lose money on those short shares. I would say the probability that this type of strategy is profitable at close to 0%. Plus, you will be forced to buy back the short calls every single month to make sure that you weren't assigned.
They give you exactly the amounts. But if you buy the stock and you sell somebody else the option to take the stock away from you at $260, you get $10,000. Problem is, you got to spend about $250,000 or whatever the math says here. Okay, and you spend $108,000 and you still get back the $37,000 or so. And so now you're in it for only about $70,000 and you're still getting $10,000 a month.
Yeah, again, but the expirations on the options are different, and the margin requirements on the shares versus options are different. The expiration dates are different, and the deltas on those options are also different. So I would never do this strategy unless I wanted to have a lot of problems while simultaneously getting stressed out and underperforming the market.
In the money, deep in the money, call as your base position. It's called a synthetic. And then I'm also selling a deep in the money strike price on the offense, right? That's what the income is. This is not a capital gain strategy. This is an income strategy. Now let me couple one more thing with it. I'm going to talk to you about delta. Delta is basically the chance.
The reason why every single covered call ETF loses money. And the reason is that you're sacrificing the upside while you're also assuming a tremendous amount of risk on the downside. I would not recommend the strategy at all.
Of it being at or above your strike price before expiration date. Well, if we go down here, we see this beautiful call that we have at 260. We've got a 75% because it's got a 75 delta of that being above $260 before your date, right? Well, it is today, so we already know that. But as the time goes by, that 75 is going to go up as long as this stock continues to stay above 260. It's got to go down by about 30 points, 28 points or so to get down to that 260. Well, a lot of stocks can do that, but stocks have a tendency to stay where they are within a little bit of a range. So the farther you go from that range, the chance that you have it. As this stock stays above 260 and as the expiration approaches, you end up making, you got a 75% to an 80% to an 85%. By the time it expires, you got a 100% chance of making this juice. Now, wherever the stock is, you're going to get the in the money amount. So if the stock is at 261, you're only going to get have to pay $1 of in the money amount, right? But you got $10 of this. And by the way, your base position, whatever it is, a stock or the deep in the money option, that moves up in this case by $1.
All right, let's briefly take a look at it. So remember, he got $38 on this, and it looks like he sold it in the beginning of May. It is the 260, June 6th. So June 6th, 260. If I was going to buy back that call option, he got $38, and now it's trading at $80. So that's a difference of $42, meaning that this option is trading for $42 more than you sold it for in early May 2025. The issue is that if you purchase this stock at $287, then your maximum profit is going to be $10 a share. So if you have 1,000 shares, then you've made $10,000. However, had you done nothing and simply purchased Tesla at $287, then you would be up $53 a share. That's $53,000 versus $10,000. So by selling that deep in the money call option, you cost yourself $43,000 in potential upside. Now let's check out that September 190. It was trading for around $110. So now that September 190, instead of 110, it's trading at 156. So that means you made $46 on the long call option, but you lost $43. So had you done nothing, you would have made $53,000. But now you're going to be forced to close out that short in the money call option because you can't get assigned due to the margin requirement differences. So you've ended up making on a net basis around $300 to $400. Whereas had you simply bought the shares and done nothing, you would be up around $53 or $54 per share.
To me, it makes a lot of sense to do $250,000 and get $10,000 a month, or you can do the synthetic and you can get $70,000 invested and you get $10,000 a month.
As we've shown you, that's not accurate. Anyway, that's about it. Selling covered calls, especially selling deep in the money covered calls with different expirations, different margin requirements, the possibility of assignment, in my opinion, is not a good strategy. If you have any questions, leave a comment below. And if you like this video, then watch the video that's popping up on your screen right now because YouTube believes that you would enjoy it the most.